Okay, we have been able to carry out our forecast, not forecast, sorry, we've been able to look at the health indicators of the firm, which is going to be the financial indicators, the returns, the profitability, the leverage, the liquidity ratio, the valuation, and we understand how well we performed over the last 4 years. Now, we want to forecast for the next 4 years, and that brings us to our fourth model, which is financial statement forecasting with an unbalanced balance sheet. And you're going to see why the balance sheet goes unbalanced. And we're going to make a couple of changes in assumptions. We're going to create assumptions concerning how we expect our finances to look over the next year, over the next couple of years. So, yes, the first thing we want to do is we want to prepare a projected income statement, balance sheet, and cash flow for Vitex Corp based on historical statements 1999 to 2002. The previous 4 years, we will then create 2003 to 2006. So 2003, 2004, 2005, 2006. From the last 4 years, we'll forecast the next 4 years. We, of course, would have assumptions that will be provided in figure 6.7. We'll have assumptions for growth rates, we'll have assumptions for ratios, we'll have assumptions for what have you that we expect over the next 4 years. We'll also include key financial indicators for management decision making. So we're going to use the model that has financial indicators, right? We're going to continue with financial indicators, only that this time we're not going to be doing financial indicators on the current, but we're going to be doing financial indicators on the future, on the future 4 years. We're going to have short-term debt. We're going to hold short-term debt and long-term debt constant. Now, this will lead to an unbalanced balance sheet, right? But we're going to deal with that going forward. But that imbalance, that difference between assets and liabilities and equity, we'll show it as discretionary funding. So we're going to prepare a position below the balance sheet, and we'll call that discretionary funding needs. Now, what will be the characteristics of this model? Well, long-term debt and short-term debt will be held constant. And at this point, we will not use a plug to balance the balance sheet because we will eventually get to use a plug to balance the balance sheet. But at this point, we will not really apply that plug, right? And then a discretionary funding line will happen below the balance sheet to show that there isn't any balance yet. Our total asset and our total assets do not equal our liability and shareholders' equity. And then this is what it's going to look like. Our forecast. We're going to forecast that sales will grow at 5%. We're going to forecast that cost of sales will continue to be 52% of sales, a little better than the historical average. We're going to forecast that 29% of sales will go into, so selling general and administrative expenses will be 29% of sales based on expected worsening. Seems like there's a little bit of inflation in the country, or it's not just as easy to make some of the payments like they were before. So you'll expect this to take on 29% of sales based on expected worsening in cost factors. Depreciation is going to be 8% of gross PPE based on analysis of the depreciation schedule, right? And then other net income will be about 7% net income or expenses. We're going to be seeing pretty much other net expenses rather to be minus 7% of sales based on historical averages. And then, of course, we have interest income. We calculate our interest income to be based on the average balance and interest rate specified later. We'll have our interest expense. For short-term debt, you calculate based on the average balance and interest rate specified later. For long-term debt, right, interest expense will remain unchanged at 13.5 million. Income taxes will be 35% of pre-tax income. So when we get our pre-tax income, we'll pay out 35% as income taxes. Balance sheet, right? Cash and marketable securities will stay at 2.1% of sales based on historical averages. Account receivables will be 8.4% of sales based on historical averages. Inventory will be 8.8% of sales based on historical averages. Another current assets will be 7.6% of sales based on historical averages. PPE will grow, that's the gross amount will grow at 11% per year based on discussions with management. Accumulated depreciation will be calculated from other items, and then PPE net will be calculated from other items, of course, which would accumulated depreciation will impact PPE, and other non-current assets will grow at 10% per year based on discussions with management. So these are the basic assumptions, right? Liabilities and shareholder equity, we have 6.1% of sales. I think it would do good to take a picture of this so that we will be able to follow from the changes. Accounts payable will be 6.1% of sales, same as historical averages. Short-term debt will hold constant at second year end 2002 level. Other current liabilities will be 8.3% of sales, same as 2022. Long-term debt will remain unchanged at 2002 level. Deferred income taxes will be 1.4% of sales based on historical average. Other non-current liabilities will be 7.6% of sales based on historical average. Paid-in capital will remain unchanged at the 2002 level, so we'll do anything to that. Retained earnings, of course, will be calculated from profitability, right, and so on, right? So we won't make any change. And then other assumptions, dividend payout ratio will be 40% based on discussion with management. Interest on short-term debt will be 7% based on economic forecast. Interest on long-term debt, we want our rates embedded in existing debt. Annual expense will be 13.5 million. Interest on cash and marketable security will be 6% based on economic forecast. And the number of shares outstanding will remain unchanged. And then the PE ratio will decline to 16. Price to earning ratio will move from 24.5 to 16 in 2003, and then subsequently improve to 18, 20, and 22 in the following years. So we're going to create a detailed assumption sheet with the same workbook. We're going to compare assumptions. We're going to compare assumptions from common size statements from model 2, right? Compare our assumptions with the common size statement. So it's the common size statement that generally will help us to be able to see what we can forecast or estimate from sales. And we'll enter formula lines based on assumptions. And also going to create an extra column to handle the assumptions. We'll avoid hard coding of growth or ratios, right? Growth rate or ratios, so that if there is changes, we can be able to look at a what if analysis and it will register. So a change in a value or in a variable, a change in a value will be a change in the variable, allowing other factors to change. But if it has hard coded, then you've changed the value and other factors will not change. Now, you want to build on model 3 workbook, right, and include statements of cash flow. You have projected formulas for 2023 can be copied into 2024 and 2026 if they remain constant. Okay, of course, they will remain constant. The projected formulas will be copied into 2024 from 2026 to from 2023 into 2024 down to 2026. And then we're going to build the model. We're going to set out what you call a forecast column. The forecast column will come in after 2026. After the 2026 year, we'll begin with model 3, right? If you remember, our model 2 was the model that we used to do. Our model 3 was the forecast model, right? The model we use to do the forecast and financial indicators and common size ratio. So we'll just go ahead and add a forecast column so that we can continue our analysis from 2003 to 2006. And then we could also separate historical and forecast years with borders, or you can hide earlier years. I would prefer to have them show and just use a very simple border to separate them. We would also create income statement formulas, right? For each line, you use the assumption sheet to define growth. We have an assumption sheet, and the assumption sheet will let us know the growth ratio or the factor. We'll enter the formula, we'll copy across, and then we'll copy formulas for subtotals and totals from the historical period. And that's how we'll simply do this. If you intend to follow up, and this is going to be the formulas. So in case you have to do this your own, this is the formulas. But we're going to do it this way, right? So between F to G, this is model 4. Between F to H, we're going to have this 2002, we're going to have 2003 to 2006. At the point J, we're going to have the forecast factor. We'll use the forecast factor and we'll plug in what we expect, right? What we have predicted into the forecast factor. And we use that as a basis to carry out our plans, right? So like I said, you want to take a picture, record this because this will guide our forecasting going forward. And then that said, let's get ready to do the work. We have the income statement formulas, we have the balance sheet formulas, right? And this is the balance sheet with the forecast factor right here. And then we'll have, of course, our balance sheet formulas. And then we'll calculate discretionary funding needs, which would simply be total asset minus liabilities and equity. And if it doesn't balance, then whatever we have there will be the discretionary funding need. It's going to be on row 59. Now you want to pay attention to the specific row and column label. Why? Because I'm using very, very specific references, right? So you want to use also very specific references so that we can be able to have the same values. And if you have to do this at some other time, right, you can just simply be able to use my own references to guide how you arrive at your own output, right? After this, we're going to calculate financial indicators, very much the same way we did in model 3, right? And that's how we will close this up. So we create statement of cash flow as expected, just the same way we created our income statements. We're going to create projected statements of cash flow from the newly projected income and expenditure statement. And that said, we'll be ready to close this out, right? So if your discretionary funding is positive, then additional funding is required. If discretionary funding needs is negative, then excess funding is available, right? We want to have flexible formulas, like I said, to allow what if analysis if the factors we place in change. And then we should try to avoid hard coding. Make sure that what we are doing is linked to assumption sheets so that we have an assumption sheet. We also have an assumption column. Let's not hard code. Let's make sure that everything is linked to assumption sheets so that we can be able to easily make updates. Now, testing the models. You want to check all models and formulas line by line. Verify totals, subtotals, retained earnings, and accumulated depreciation. You want to review financial indicators for consistency with your assumptions and projections. And then, of course, this model supports planning, forecasting, what-if analysis, and the evaluation of the impact of one activity on the financial statement on another. It allows you to quickly test changes in growth rates, ratios, and cost structure. In fact, this is actually the first kind of what-if analysis that we will really perform, right? We should aim for flexibility because different forecasting factors can be created per year or per period if needed. You want to keep your assumptions minimal. Don't overcomplicate your projections. And you can incorporate decision rules or constraints in future iterations of the model. And this brings us to the end of this. When we return, we're going to handle the practical aspect of this, and I hope you get to enjoy it as much as you have enjoyed this discussion. Well, thank you very much, and I'll see you in the next video. Bye for now.